Namaste and good evening, everyone. Welcome to today's webinar on Equity Market Insights by UTI Mutual Fund. I'm Sonal Mittal, Product Specialist at UTI, and I'll be your host for today's session. The last few months have been quite interesting for Indian markets. After 4 consecutive months of selling, we saw foreign investors turn net buyers in July. At the same time, markets continue to navigate several cross currents: global rates, geopolitics, crude oil, currency movements, and importantly, the earnings outlook. So, the question really is, what could drive markets from here? And today, we will look at that from two perspectives. First, broader market and macro outlook, and then we'll take a deeper look at one of the key themes in Indian markets: consumption. To help us with that, I'm pleased to welcome our speakers for today. We have with us Vetri Subramanya, our MD and CEO, who will take us through the market environment, key developments he's watching, and his outlook for equities. Vetri, thank you for joining us. And we have Vicky Punjabi, Vice President and Fund Manager at UTI. Vicky has more than 2 decades of experience in equity research and investments and has spent a significant part of his career tracking consumer-facing businesses. He joined UTI in 2022, covering FMCG, retail, paints, and consumer durables, and has been managing UTI India Consumer Fund since June 2025. Vicky, thank you for joining us. So let's get straight into the conversation. Vetri, let me invite you to kick us off. Over to you.
Good evening, everybody, and welcome to this edition of the Equity Market Insight. And as usual, we've put together a series of charts and data points, which hopefully will be of interest to you and will also answer some of the questions that may be on your mind. And as far as any questions that remain unanswered during this presentation, feel free to continue sending them in, and hopefully we'll have some time at the end for Q&A. But without any further ado, let's get going for the evening. Over to you, Sonal.
Let me start with something that has been a key focus for markets over the last few months: the West Asia conflict and its implications for crude. We saw a sharp drawdown in global oil inventories during the disruption. How are you looking at the crude supply situation from here?
Yeah, sure. Thanks for that, Sonal. Yeah, and I think hopefully you can see this, slide which is on the deck right now, which is on the screen right now, and this essentially shows you the pattern of what has happened to crude oil in terms of the inventories. Now, if you had asked any of us going back to, let's say, the first week of February, everybody and most of us were concerned about the fact that there could be a big spike in oil prices. Remember, 20% of the world's oil flows through the Hormuz Strait, which is where Iran is. And therefore, there was a big concern that with 20% of the oil not flowing, and maybe an even slightly higher portion of LNG that the world requires flows through that strait, the big concern was that there would be a big spike in oil prices. Now, of course, oil prices still remain higher than where we were in early February, compared to $65, $67. Brent crude, as we speak today, is closer to 87, 88. So it's up almost about 30% from that level. But the concern was that it could have spiked a lot more. The reason the spike doesn't happen is the chart that you see on the screen. If you look at the middle of that, where there is the zero line, when the bar goes significantly below the zero line, so that essentially happens at March 26, and then all the way March, April, May, June, July 26, you can see that the bar is more below zero than it is above zero. These are the months in which inventory is being drawn down. If you look at the bars for January and February, you'll see that from the zero line, they are actually moving upwards. So these are the months from February onwards, March onwards, where we have been drawing down inventory. Some of the inventory was already on the water. Some of the inventory was held by the OECD countries in their strategic reserves. Then, of course, China also holds a large amount of reserves. and everybody has been drawing down their reserves. And in addition, China actually reduced its imports quite significantly. So, as a result of this, even though crude supplies came down sharply, there was no spike in prices because everybody ran down their inventory. Uh, and to the extent, of course, that we have still not reached full normalcy, there is still some concern. And in any case, we suspect that over the next 6 to 12 months, most large countries will also start to simultaneously fill their inventories as and when normal supply resumes. But the big reason why prices did not spike up is inventory drawdown.
Thanks, Vetri. Let's move to another important macro variable, rates. We have an interesting situations where the Fed rates hiking cycle is on hold, but long-term bond yields remain elevated. How do you see this divergence between the policy rate outlook and long-term bond yields?
Sure. Good question, Sonal. And, I think at the heart of, I would say, the fundamental problem that the US economy in particular is experiencing is very simply the fact that US government debt continues to rise at what I would call, or rather, the only way to call it is that this is a unsustainable pace at which their debt is increasing. You can see on this chart over there, it's literally like a 45-degree line in terms of the growth of US government debt. And remember, they're continuing to run the fiscal deficit at about 6%. Very unusual for the US economy to be growing strongly and simultaneously running these huge deficits. Historically, in the past, they've run up big deficits when growth was weak and they were in a recession, and they've typically tended to come back towards a balance when growth was strong. But right now, one reason why their economy is also extra strong is simply because the fiscal remains very supportive. So when you have this kind of government debt and fiscal deficit, it means you will continue to issue debt, and that itself is putting pressure on the yields. How significant are the yields, Sonal? We can see that on the next slide. If you look at the next slide, this is the US 30-year sovereign bond yield currently at 5.14%. If you look at that orange line, that level was last seen almost 20 years ago. Basically in 2005, 2006 is during the period where you last saw bond yields at this level. So this is certainly a matter for concern. The fact that they are continuing to be so reliant on borrowings means that there is increased supply of bonds, and that is keeping rates high. Those of you who've also been following the news would have noticed that recently the US supported Japan in terms of an intervention in their currency. And one of the reasons apparently why they did it was that they didn't want Japan to liquidate their holdings of US treasuries to bring it back to prevent the yen from depreciating. So to prevent the yen from depreciating, they told and to prevent Japan from withdrawing its money from US treasuries, US Treasury actually made a line of credit available against the treasuries to Japan rather than having them liquidate the securities. So certainly this is something that US is also feeling quite nervous about. And remember, when you value all asset classes, you discount them at what we call the risk-free rate, and that risk-free rate is nothing but where we see longer-term yields. And so when you see these longer-term yields at such high levels, indirectly it should require asset valuations to get compressed, because when you discount cash flows at a much higher rate, the value of those cash flows in today's terms comes down.
That's interesting, Vetri. The fiscal backdrop seems to be an important part of the story here. Let me stay with the global macro picture for a moment. These days, any macro discussion doesn't really feel complete without talking about AI Capex. We have seen a strong investment cycle. What's your take on how long this cycle would continue? And how do you explain the sharp correction we've seen in some of the tech hardware names?
So, Sonal, we can take a look at this. And the first thing I should say that every cycle is different. So these are four US spending cycles, oil in the 70s, technology in the 1990s, US shale gas in the 2010s, and AI, presuming that the start date is somewhere around 2020, though I think ChatGPT itself, entered popular consciousness more in 2023-24. But if you take this as the cycle, then what these lines show you is how the capex accelerates. Capex in that particular sector as a percentage of GDP, how high does it rise, and then when does it mean revert, meaning it goes back to the starting point. Now, when you look at that, you'll see that the strongest investment boom actually happened in oil in the 1970s. The current spending boom in AI is the green line. It is accelerating significantly, but it's actually slightly smaller than the 1990s tech spending boom and also the AI boom, but still of significance, magnitude. Having said that, it is nowhere near peaked. We are, let's say, 24 quarters into the cycle, 6 years into the cycle. Previous cycles have gone on for slightly longer, but I think there are some reasons one should now look beyond current spending trends and think more about the sustainability. So yes, this cycle is not as long in terms of age as previous cycles, but there is still some reason to worry. And the reason for that worry we can see on the next slide. Now, every investment boom needs to be financed. Now, when financing comes from the intrinsic cash flow that the companies are generating, it is very easy for them to fund their cash flow. And when you have Capex, which is running capital expenditure, running above the level of operating cash flow, then you have only two options as a company. Either you raise debt or you raise equity. What we are seeing in the US now is a combination of both. The big issuance is happening in debt, but we are also starting to see companies that were historically seen as free cash flow generating companies. Great example being Google parent, Alphabet, historically seen as a massive free cash flow company. They actually did an equity raise, a few months ago. And in fact, they messaged to the market that next year's capex would be about 200 billion, which would be well in excess of the operating cash flow that the company generates, which means they would have to rely on some debt issuance as well. So yes, the growth in capex has been significant, but we are now reaching a point where capex, capital expenditure, exceeds operating cash flow. So rather than look at just the rate of growth in capital expenditure, I think investors now will start to raise the question, okay, great that you're investing capital, but what is the return on that capital going to be? And therefore, when you get to this point, all these investment decisions come under the magnifying glass. And therefore, as a result, my sense is that we are now closer to a peak in AI capital expenditure than before. We can also see signs of this when we look at the next slide. And here we are just tracking the bond issuances by these large hyperscalers. Of course, even though they were net cash, they always issued some level of bonds. But you can see there is a dramatic escalation in the kind of bond issuances that they have had in recent times, from literally $20 billion to almost $200 billion of issuances in the current year. So that's a dramatic increase in bond issuances. Not only have they raised the level of debt that they are raising, but equally what has happened is their credit spreads, at least for some of the issuers, has gone up dramatically. So for some of the hyperscalers, the credit spread has almost doubled from 70 bips to 140 bips. And there is a lot of evidence to suggest that companies are now moving their investments into AI, the data centers, off their balance sheet. And a recent article in the Financial Times, based on some analysis by Goldman Sachs, suggests that the lease commitments, which are still not recognized as a liability in the books of the hyperscalers, now exceeds $1 trillion. So these are massive numbers that we are, starting to talk about. Finally, if we just look, I think we have one more slide here. Yeah. Now, what happens when companies are investing at such a dramatic pace? Now, one company's investment is another company's earnings, right? Because when you're doing capex, it gets booked as revenue by somebody else and it shows up in their earnings. So we are in that sweet spot right now where the hyperscalers are also growing their earnings simultaneously because they are investing so aggressively. There is a massive growth in earnings which is happening across the world. Just take a look at that 2026 column, and you can see the signs of that. The all country world index earnings growing at 29%, Europe growing at 14%, Japan growing at 21%, the US, of course, the superstar, growing at 28%, given the size that it is of the global economy and two-thirds of global markets. And then, of course, you've got Korea and Taiwan, which are going through a once in a lifetime profit boom. And you can see those numbers over there, extremely dramatic. And in that context, both India and China, which are otherwise, large economies, growing at a very healthy 6-7% nominal growth rate, but a real growth rate. But look at that earnings number, just 12%. Of course, going into 2027, the expectation is that India's earnings would accelerate slightly from the current trajectory, and it will look more comparable to the rest of the world. But again, just about comparable to the rest of the world, not necessarily better than the rest of the world. So the other big picture to take away from all of this, Sonal, is that yes, there is massive capex happening, but we have reached a point where we should worry about the sustainability of capex. The question is now about the return on capex. But what is so much capex doing? It is getting converted into revenues and profits in the books of companies, and that is getting reflected as strong acceleration in global earnings growth.
That's a useful distinction, Vetri, between the sustainability of underlying AI investment cycle and what the market is willing to pay for the companies benefiting from it. Let me bring the discussion back to India now and to another investment cycle that has been closely watched, corporate capex. How has listed corporate capex spending been, and how are you looking at the capex cycle from here?
Sure. I think we've had this conversation before. India is not really participating in the global, AI-led capital investment boom. Very marginal supplies from some companies going there. So we're not really participating in that. But having said that, in the last 5 years, capex has doubled. If you look at those blue color bars, in FY21, we had 4.5 trillion rupees of capex by the BSE 500 companies. That number in 5 years has more or less doubled to 9.4 trillion rupees. Now, of course, BSE 500 is only a small set of the total capex which happens in the entire economy, but still it is a remarkable number that it is doubling over a 5-year period. So that's a CAGR of almost 14%, Sonal. But keep in mind that for literally the previous 5 years, that capex number had not really grown much, right? So even if you go back to FY15 or FY17, the capex was about 4 to 4.2 trillion, and even in FY21, it is 4.5 trillion. So over a 10 or 11-year period, it's a single-digit CAGR in capex. Not very exciting, but certainly the last 5 years have been very, very good. And it reflects some buoyancy that we've seen overall in the economy. But we are not benefiting from the global AI capex boom. The good news, if you want to call it that, is that the capex in India has been completely backed by operating cash flow. So operating cash flow has increased by 50% over the last 5 years. And you can see this in the data, therefore, that operating cash flow has funded most of our capex. And that's why the debt equity ratios of corporate India are not very elevated.
Rightly captured, Vetri. There does seems to be a meaningful improvement in corporate investments, although broader private capex stories is still something we need to watch for breadth and sustainability. That brings me to my next question. Domestic flows have remained strong, and FIIs too seem to be turning buyers in the near term. How do you see the flow environment from here, and what could it mean for the markets?
Sure. So, Sonal, this is something that we've covered multiple times in this conversation, and we've kept saying that you need to look at supply as not just a function of what happens on the IPOs, which is the new share issuance, but IPOs plus OFS plus private equity, VC sell downs, promoter sell downs, so on and so forth. And you can see the trend line for this for the last 5 years. 2021 was, in retrospect, a very mild year, or rather, 2022 was a very mild year. But you can see that 25 was a record year, and then 2026 as well is turning out to be a fairly strong year, even though we had the month of March and April, which was very quiet because of the whole Iran conflict issue. But as of now, I would say the trend looks very, very buoyant in terms of equity capital market activity. When we say ECM activity, we are including all the sell downs that are happening, not just new issues. Remember, we've already seen some marquee OFS and other transactions in the first 6 months of the year. The most awaited IPO of the year is still around the corner, which is going to be that of the NSE. And then, of course, you've also got one of India's largest retail companies, which is expected to go public during the second half of this year. So I won't be surprised if this worm, which as of now is moving very close to what the worm looked like in 21 and 2025, actually starts to follow the same trajectory. So very healthy supply. We just got the number for last month. I think it came at about 32,000 crores of SIP, though total flows was slightly lower because of redemptions at about 27,000 crores. So we've got good domestic appetite for equity. The good news at the margin, Sonal, might be that in the last 1 month, after many months of remaining sellers, foreigners have actually turned net buyers. So, even if they don't remain aggressive sellers and just remain marginal nominal net buyers, that should hopefully keep the balance even between where the supply is and where the demand is.
That's a useful way of looking at it, Vetri. Let me now come to the two things that investors eventually care about the most: earnings and valuations. How are you looking at the earnings outlook for Q1 FY27 and the trajectory from here? And it would be great if you could also give us a perspective on current valuations and what our proprietary equity valuation index is signaling at this point.
Sure, Sonal. So now we can run through what I call pretty much our standard set of slides. So you always get a sense of where we were last month and what we are looking at today. So the current estimate for March 27, I've always said news. We'll talk about that on the next slide. But this is the current estimate: 17% earnings growth for the Nifty 50 in March 27, followed by 11% earnings growth in March 28. This is sort of the broker consensus at this point of time. As you know, we are almost getting to the end of the earnings season for the June quarter. And the numbers are showing some improvement. Sonal, we can see that on the next slide. Now, here what we are tracking is that for the Nifty 500 companies, what percentage of the companies have revenue growth and profit growth of greater than 10% year on year. Remember, there was a significantly elongated period in 24-25 when nominal growth rate of GDP was just about in single digits, 9%, just below 10%. We were seeing the number of companies reporting more than 10% year-on-year growth was, just about 50%. But we did say that in the current year, we see an acceleration in nominal growth, and that should help the reported numbers. We are seeing clear signs of that, Sonal. Not all 500 companies have reported, but for about, I think, 340 or 380 companies which have reported, almost 76% of them now have greater than 10% year-on-year growth in profits, in revenue, and 66% of them have greater than 10% year-on-year growth in profits. This is pretty much the best number that we've had in almost 3 years. So, what we were talking about earlier, that higher nominal growth in GDP will get reflected in revenues and profits, is certainly happening. We can also see the trend for the current quarter, or rather for the June quarter, in the next slide. For, as I said, about 370, 380 companies who have reported, 398 companies, I should correct myself, which have reported numbers so far. The adjusted PAT growth is 14%. So this is adjusted, this is not as reported. So it's all adjusted for extraordinaries, 14% profit growth. And there are different ways in which you can look at this. If you take the banking and financial is 90 companies. And therefore, 308 companies are non-BFSI. Their profit growth is 7.3%. Now, you would say, hey, that seems to be a slightly disappointing number. Reason for that is that there was a big setback in profitability of some of our commodity companies, particularly oil and gas companies. So if you come down that slide, what you'll see is the bar chart for commodities, cement, oil and gas, metal mining. Those 38 companies have a minus 12% performance in terms of their profit growth. If you exclude them, the remaining 360 companies in the Nifty 500, excluding commodity companies, had about a 19% growth in profits. But of course, you can keep cutting and slicing, but always be careful. In fact, 2 quarters back, the entire profit growth was being supported by commodity companies. Now it is a detractor from earnings growth. So it's always good to see the aggregate. But the good news at 14% aggregate profit growth is that these numbers are very strong. And remember, I talked about 17% profit growth for Nifty 50. This 14% means, yes, it's a big bar, but it's still within sort of the run rate that could be achieved during the remainder part of the year. Moving on from that quickly to our standard slides on valuation. I'll spend more time talking about the indicator, but very simply, Nifty 50 trailing PE on the left, forward PE on the right, both are in the white zone. When it is in the white zone, it is fairly valued. The next slide shows you the price to book ratio. This is not only in the white zone, it is below the horizontal dark blue line. That's the average level. So we are now well below average on price to book, and at the same time on the right hand side, ROE remains closer to cyclical highs than cyclical lows. So this is actually what I would call a reasonably favorable setup. What does the picture like if you look at the mid caps and the small caps? Here the picture remains challenging. Mid caps on the left hand side still in that red zone, which is expensive, and the Nifty small cap dipped briefly into fair value zone, but still in back within that pink red zone of being slightly expensive, both on a price to book basis. So I think from a valuation point of view, there's a lot more comfort in the large caps as compared to the mid caps and the small caps. However, Sonal, I think, the larger message I would want to give. Okay, there's one more slide that we have. This is just to show you what has happened over the last 1 year and 2 years. We've been of the view for a while now that large caps is where there is more comfort. On a 1 year basis, this is surprising outcome, which is that the mid caps are up 9%, small caps 5%, despite the valuation challenges. Though on a 2 year basis, the gap is now quite negligible. Nifty 50, Nifty 100, Nifty small cap pretty much in line, and the Nifty mid cap slightly ahead at 3.5% CAGR. So not much has changed in terms of our view that the preferred risk reward is favorable only in large caps. But let's take a look at the next set of charts, because that will take you to our proprietary equity valuation index. I think the message over here is unambiguous, right? There were times in 22, 24 where we kept saying this is very, very uncomfortable, decrease equity allocation, rebalance your portfolio away from equity, equity values are elevated. That is no longer the case. The market is now very clearly in an increased equity allocation zone. I should clarify, when we say market, we are still referring to the Nifty 50, because this 10 years of data that you can see here, as well as the historical data, only relates to the Nifty 50. It does not relate to the small caps and mid caps. But the message from our proprietary equity valuation index is very clear. You can increase your equity allocation in this zone, particularly if you're doing it in favor of large caps. So moving on from this slide, just to show you how does that chart convert into historical data. Just look at that light green column at the second from the bottom. If you look at historical data, 209 times, which is 30% of the time, the market has traded in that increased equity allocation zone. If you had invested lump sum at that point of time, your average 1 year return was 14%. Doesn't mean it is always 14% because that's the average. The best return as high as 52%, equally the worst return minus 21%. But I think what is really favorable are the next two columns, which is when you invest in this zone, there is only a 7% probability of getting a negative return over a 1 year basis. And there is a 56% probability that you get a greater than 12% return. So this is why this zone is something that we call the increased equity allocation zone. The only point in time where the data looks even better is when the market falls into the increased equity allocation zone. So I think that's the message to remember in terms of why we call it the increased equity allocation zone. Lump sum investments in this zone are favorable. Moving on to our final slide, just a summary. We should worry about the continued rise of global yields because this impacts the value of cash flows in the future and effectively, therefore, acts as a weight on valuations. AI capex growth still very strong, but as I said, you need to worry about the rising debt. You need to worry about the lease commitments, which are still not recognized on balance sheet. And at some point, the market will start to worry about return on investment rather than growth in investment. We already talked about RBI's special schemes to raise money. By RBI's own data, over 40 billion had come in as of July end. So, we had talked about estimates of 60, 70 billion. I think very well on track to maybe get at least 70 billion, maybe some estimates even above 80 to 100 billion are being talked about. I think this will help RBI heal its balance sheet to some extent and is very, very positive for domestic liquidity. I was just talking to my fixed income fund managers, and they are saying the short-term yields have come off very sharply simply because of the increased domestic liquidity. MPC kept the rates unchanged in August with a marginally improved view on growth and inflation. We already talked about the Q1 27 very encouraging trend. Again, 17% for the full year is a high bar, but the first quarter, like the first 5 overs of a 2020 match, is putting you in a good place in terms of the required run rate to get there. We've talked about the in-house equity valuation index. It is in the increased equity allocation zone. Finally, happy to share, because we've been saying this for a long time, that value has seen a strong cycle of outperformance over quality growth in the last 5 years. And we've been of the firm opinion that there is an opportunity for mean reversion here. I think the financial year to date trends over the last 3 months certainly suggest that there is now a visible sign that quality growth is starting to outperform value. So that's a trend that we would suggest investors should continue to monitor. And we think this trend has more way to run. But I'll halt at this point and hand over, as Sonal said, to Vicky. Vicky is a fund manager at UTI, also analyst of over 20 years of experience. And a large part of his career has gone into tracking the consumption sector across multiple dimensions of consumption, first on the sell side and for the last 4 years with UTI. He is the fund manager of UTI India Consumer Fund. Congratulations, Vicky. When Sonal introduced you, I realized that you've now completed a year. So congratulations on that. Over to you, and you can take us through your strategy.
Thank you, Vetri. Welcome, Vicky.
Thanks, Sonal. Thank you, Vetri.
Yeah. Vicky, perhaps let's start by defining the consumption opportunity for us. When you look at the Indian consumption universe, how do you define the theme and the opportunity set?
Yeah. Okay. Good evening, all the listeners. Firstly, so on consumption, Sonal. See, in a way, we have always, if anyone thinks about consumption, it's always, foods that come to the mind. That's the first thing that we always think about. The truth is, we have actually evolved a lot more than that. And if you think from the company's perspective, right, they don't think of consumption as pure play consumption. They actually think of solving problems. So instead of consumption, they would call it a problem of hunger to be solved, where you get the foods part of the business, where a problem of leisure to be solved, where you could have media, something like Netflix, YouTube, a problem of, a stay, possibly hotels, resorts coming into play. So these are the various problems that get solved. And let's think about solutions. And when I talk about solutions, think about mutual funds, right? We are solving for investment problems of, the mutual fund industry itself is solving for many of these investing problems in many different ways. We are creating products for them. We are improving access for them. We are also educating and spreading awareness. So, I'm sure most of the listeners out here kind of relate to the space, to the investing space well. So, I would say the consumption theme is very, very broad. It's not just related to products. We cover services as well in this. It covers the entire business to consumer space, where businesses are directly interacting with the consumers to solve their problems overall. So yeah, so it's quite a broad space. If we move, if I had to just talk about an inclusive list of sectors that we could cover in consumer fund per se, we do cover telecom. It's a direct interaction, right? Where mobile companies, the consumers are directly interacting with telecom service companies. So it's the same thing, whether it is financial services, whether it is automobiles, media and entertainment. So everything, the whole list is there for the audience to see. But the more important part out here is to understand that, when we talk about incomes, there are generally two parts of the income. One is consumption. The other is savings. And this B2C opportunity actually captures both. It captures consumption, but it also captures the savings opportunity, the investing opportunity, the financialization of savings opportunity per se. So it's kind of broad in that terms.
Yeah. Thanks, Vicky. So when you look at this opportunity set, how do you dissect the Indian consumption opportunity? What are the key aspects that you look at?
Right. So, see, India could be one of the possibly only large economy that would be growing consumption, right? And there are many factors that are kind of influencing it. One of the factors, of course, we have a growing population per se. But that's a lower part of the growth. But the other major factors, which is demographic dividend. So if you see this left hand side chart on the screen, the orange bar actually represents the population in the age group of 15 to 64. That's the actually working age population. A larger part of that population is the working age population, and if you see that, that's been increasing for India. So that's in itself driving a demographic dividend. So you have a larger part of population that's earning incomes, and lower part of the population that's more dependent. Similarly, on the right hand side, if you look at it, it just kind of shows you the disposable income in India, which is growing at a 12% CAGR over the years. So you have more people working and you have people earning more. So there is a larger part of pool for consumption per se. So those are the real factors that are driving the overall consumption in the economy per se. Now, this is the other way to look at it, and the importance of this. It's good to understand the importance of this. Now, if I focus this is basically categorizing the entire population or entire households in India in different buckets basis their income capacity, right? And in 2010, if I had to look at the top two buckets in terms of income capacity, which is elite and affluent, they constituted 6% of our economy. In 2025, they are actually constituting 23%. Now, this is important because these buckets actually, while they constitute a smaller part of our economy, they actually drive a larger part of the consumption. They would be responsible for more than 50% of the consumption economy. And if this bucket is growing, the growth is consumption is more likely to be much more healthy than not. So yeah, so probabilities in India actually favor consumption in a way.
Sure, that's an interesting way to look at this opportunity. Within such a broad universe, there are obviously very different businesses and consumption patterns. So, what are the major sub themes that you see within the broader Indian consumption opportunity?
Yeah, so in a way, consumption is a theme. So most of the other themes become sub themes. Thanks, Sonal, for identifying that. But yeah, so there are broad. If I had to classify it into broad trends that are prevailing within consumption, they are like, and these are cliched. Okay, these are cliched ones. Everyone knows it. But I'll just delve on the importance of it. So one is premiumization. I mean, everyone knows that there is premiumization within Indian economy. But if you look at it on the left-hand side of this of the slide, there's a chart which talks about the SUV share of the passenger vehicle segment in India, right? And this SUV share in India's passenger vehicle segment, which used to be 15% in FY15, it's grown to 55% in FY25. SUVs are always more expensive versus sedans. So that tells you that people are actually spending more on cars that they are buying. Now, this is one way to look at it in within cars, because cars is very highly aspirational, so it's prone to premiumization, and the trend of premiumization is very, very visible. Now, just to say this, when this SUV trend started, Maruti Suzuki had lagged in this trend. After 2020s, when they kind of launched a lot of vehicles in the SUV segment. So if you look at it from Maruti Suzuki's historical performance, from 2020 to 26, they have seen a 9% CAGR in realizations. Now, of course, prices have not grown to that extent. So it kind of implies that the premiumization-led story is actually played out in their realization. So they have actually sold more products that are higher in value versus what they used to sell earlier. So that's one part. Of course, on the right side where we are talking about housing is also very aspirational in India. And there, even in this case, if you look at the topmost part of that chart, which is pink in color, I guess, so that represents the higher ticket size housing, higher ticket size, which is above 10 million, and that as a proportion of total housing sales has moved from 16% to 44%. From CY18 to CY24. This is a very short period. Okay, it's a period of 6 years, yeah, approximately, yeah, and you see the sharp shift that we have seen. So premiumization as a story remains very, very strong in India, and I think that would kind of continue. Yeah. So if we move on to the next slide, and this is the other cliched story, unorganized to organized. But trust me, it's one of the, I think, one of the very strong stories that's playing out in India. I mean, on the left-hand side chart, it talks about, in FY25, we have something like a 24% of our overall retail market, which is actually organized, only 24%. We're talking about by FY30, it reaching around to 30% levels. That's the kind of sharp jump we are seeing in the organized space. Now, it's interesting that the overall the retail space itself will grow somewhere closer to double digit. It will be somewhere closer to the nominal GDP growth. So that's why you will see the organized part of the segment will be growing much sharper than the overall part of the segment. And if we had to look at the possibility or the opportunity out here, India is 24, China is 50 to 60% organized. US is something like an 80 to 90% organized. Of course, I don't think we are going to that levels of 80 to 90%, but of course, 50% is something that we can strive for in the near term. So this is, and think about companies that have actually capitalized on this, right? In the jewelry space, Titan. I mean, it's been one of the great stories. Again, I mean, these are no recommendation of stocks that I'm doing, but I'm just citing examples out here. It's been a great story about moving from unorganized to organized. And yeah, the third one, which is also another a very strong theme. It's more about when working age population increases, when women's also start working, the importance of convenience within the economy actually goes higher. And that's what we are talking about here. If we look at the e-commerce penetration, e-commerce is generally an enabler of convenience, right? Today, quick commerce as such, you just order today, in 15 minutes you have your groceries at home. It could be unimaginable, say even 5-6 years back. So those are the kind of convenience that we are striving for. 3-4 years back, we didn't even believe that these kind of models could make profitable sense, and today we are seeing profitability out of these models. So if you look at the convenience part in grocery, it's kind of, I mean, the chart shows that it used to be 1% in FY20. Today it is doubled to 2%, and possibly quadrupling in 4-5 years time. And you can see that happening across segments per se. So these are three broader themes in the consumption space, I think. And I can't stress enough, while these are cliched themes, these are the most important parts of investing within consumption, in my view. These are the trends that we need to really capitalize on.
Thanks, Vicky. You have rightly captured the several distinct opportunities within the broader consumption theme. But despite the long-term structural story around Indian consumption, the sector hasn't really been a consistent market outperformance in recent years. We haven't seen a stronger performance from the consumption space over the past few years. What, in your view, has held the theme back, and how are you looking at the outlook from here? What are the key signs or evidences, if I may say, you are watching to validate that outlook?
Yeah, sure. So thanks. That's an interesting question. I think a part of that got answered in the early slide when Vetri was talking about the AI Capex, right? I mean, the narrative of Capex industries has been so strong, and you yourself made those words, right? And any conversation without talking about Capex is incomplete. So yeah, that's one of the parts where consumption got completely overshadowed over the past few years. But yeah, I wouldn't disagree. There have been headwinds on consumption. A part of it was also driven by the base effect. After, when we came out of COVID in FY22, there was a kind of very high pent-up demand in FY22-23, which created a very high base for these consumer companies in a way. But beyond the base effects, there were also regulatory headwinds on consumption. Now, just on this slide, when I talk about it, you can see the interest rates, for example, from, I think it was in FY23, when government actually, the RBI actually raised the repo rates from, I think, around 4.5% to 6% plus, 6.5% in fact. And then it's been stable. It was stable in that zone for the next 2 years. So interest rates, see, leverage is an enabler for consumption. If leverage becomes more expensive, it impacts consumption. Government actually tightened the unsecured loans as well. RBI tightened the unsecured loans norms around unsecured loans as well, which was the other headwind. Government increased taxes. Capital gains taxes actually went up. There were no relief in income tax, no relief in GST. So this was a tough time for consumption, right? With so many regulatory headwinds, with such high base, at that point in time, we had seen many of the companies struggle to get. I mean, forget the companies, even the growth in private financial consumption actually struggled at that point in time. So there were high headwinds, but that's a thing of the past. Luckily, at the end of FY25, I think consumption is 60% of the GDP. If government wants to really accelerate the economy, consumption has to accelerate finally. And the government was kind enough. We saw many of the tailwinds emerging at the end of FY25. There were interest rate cuts. If you look at income tax, right, there was a huge relief that was given to the taxpayers in FY26, of course, at the start of FY26. And then in September 25, there was a GST cut, sharp GST cuts on autos, and so many of the food products seeing a very sharp cut. So there was a reasonable flip to consumption that was given in FY26. And then, if you look at it, what happened, and I'm taking these two examples because these are two companies that are actually urban demand-oriented companies, right? And the urban consumer is the one that actually gets impacted with all these aspects. And if you look at the recovery in the revenue growth rates of these companies, right? So metro brands, I mean, I'm sure many of them know it. Many of them have experienced it. It's a footwear seller, ladies, athleisure, everything under one roof. If you look at the growth rates there, 9% in Q1 moved up to 11% in Q2, up to 15% and 20%. So there has been a scale up. Similarly, Nestle India, famous for Maggi, famous for chocolates like Munch and Kit Kat. You look at the growth rates there. It's 6%, 11%, 19%, 23%. Every quarter by quarter, these companies have shown an improvement in growth rate. So consumption tailwinds from regulatory environment did really help. And this, as the base also did get a little more favorable. So yeah, that's the part of it. What I'm trying to say out here is that the tailwinds of consumption is not expected in future. It's all actually happening on the ground today. We are actually seeing consumption improve. So the growth rates are improving, and if we go to the next slide, this is so you have a good healthy growth rates. Valuations, of course, have trended up. I mean, there has been a recognition. Markets are wise enough, but let me just take a step back, explain this chart a little bit. This is actually a chart where we are comparing the valuation of consumption companies versus Nifty 50 companies. Right, so the P multiple of consumption companies versus P multiple of Nifty 50. On an average, it is trended around 1.8 times, which means that consumption companies are trading at an 80% premium on an average to Nifty 50 companies. Consumption companies are high cash flow, low working capital, high ROCE businesses, so they tend to trade at premiums. If you look at it today as well, we are still in that average zone. We are not expensive per se. Just to highlight from Vetri's slide earlier, Nifty 50 is one which is very, on the valuation parameters, Nifty 50 is much more comfortable on valuations versus mid caps or small caps. So we are comparing with an index which is very fairly valued, and even against that, Nifty consumption itself is fairly valued. So at that point in time, I'm saying growth rates are improving, valuations are reasonable, and the momentum generally tends to continue till we see keep experiencing healthy growth rates. So yeah, both risk reward actually seems quite favorable in this context.
That's definitely useful, Vicky, particularly the point around the indicators you're watching to assess whether the thesis is playing out. So we have talked about the opportunity, different segments within consumption, and your outlook as well. Let me now bring this to the fund itself. Could you take us through the investment strategy of UTI India Consumer Fund, and perhaps also give us some insights into your current portfolio positioning?
Yeah, sure. The investment strategy actually first starts from the universe, which is B2C, and I did explain that in detail. It's not just consumer. We also look at the savings part of the business of the consumer wallets. Beyond that, I think one of the parts is we in this fund we prefer to own companies that execute well, that focus on every part of the execution, whether it is revenue growth, whether it is margins, and whether it is conversion to cash. So, a company that has this kind of an holistic view, it tends to surprise you on the upside. There are many surprises. We've seen that. I'll again repeat these examples that I keep saying. Something like a Titan, right, and Tanishq. We've seen that that surprises coming through over the last 2 decades. That's a kind of preference we tend to have. We do emphasize on the longevity of growth. It's basically addressable markets. When I made that point, unorganized to organized. So there is a smaller organized presence, 20% organized presence. You still have an 80% of the market that needs to be captured by these companies, right? Getting back to Titan, it's just 8% of the jewelry market today. So that's the kind of opportunity that it still has. So longevity of growth, strong execution type, track record. The other part out here, which is important, is we invest where we feel we have an edge in terms of understanding of the company, where we understand the company better. and we back that up by our convictions. We back our convictions with our position sizing. Now, just Warren Buffett terms it as circle of competence. We try to remain in that constraint of circle of competence where we understand the companies better. And the reason, the reason is simple. I mean, and let me get back. I mean, somehow this example keeps coming back to my mind. When a government raised customs duty on jewelry, right? I mean, if I didn't understand the market well, or if the fund didn't understand the market well, there could be a panic in terms of what would happen, because it creates uncertainty. Any new event tends to create uncertainty. But when there is an understanding, there could be a much more informed decision about that. So while the stock did see volatility, we kind of saw that as an opportunity in the fund itself. So I think that's the way we treat. That's the way we feel comfortable. Of course, while I talk about circle of competence, we scan every opportunity, because that helps increase the circle of competence per se. So yeah, that's the larger part. The last part, of course, which is also very, very important, is valuations. And valuations actually reflects in our positions as well. So if we see these kind of opportunities being very, very reasonably valued, then we kind of increase our positions. If we see that valuations are kind of getting stretched, then we reduce our allocations to these stocks. So yeah, so I think that's how we try and kind of position our portfolio basis the risk reward. And this is kind of getting back to the themes when I was talking about. So on the left hand side there is food and beverages. On the right hand side there is transport, which is basically the sale of these cars and bikes and stuff. Now this left hand side chart is actually talking about the share of consumption of food and beverages. It used to be 45% in 1999. It is 30% today. Natural decline. As the incomes evolve, consumers tend to become more. The disposable income tends to go more towards discretionary items and less towards foods and beverages. So if you look at it that way, and the second thing is on the right hand side, you're seeing a clearly opposite trend where with the cars and bikes, people are actually increasing their spends on that. It's moved from 11% in 1999 to 17% in 2024. And if you look at our allocations are exactly in that way: 6% in food and beverages, 25% in these sectors which are low penetrated, which have greater growth opportunity. So we are actually trying to capitalize on these themes in this fund. And then just in terms of positioning, I've talked about. I've talked about positioning in a way. Autos would be a larger part. FMCG, while it is 13%, understand. We also mirror a benchmark which has 24%. So it's actually an underweight, sharp underweight in our segment. There is one more, which is financial services, which I talked about. Trying to capture the savings opportunity in India. So yeah, so I think that's so we are constructing our portfolio basis that per se. Just to conclude, in a way, consumption itself will grow with demographic dividend. There are these three large themes that are prevalent in terms of premiumization, unorganized to organized, convenience. And within our portfolio, we are looking at capturing all these themes. We are looking at companies that drive healthy cash flows, ROICs, that can actually benefit from the policy tailwinds. And we are trying to be reasonable in terms of valuations, at least. So that's the broader context is in what I wanted to talk about in terms of UTI Consumer Fund. Thank you.
Thanks, Vicky. That gives us a good perspective on both the consumption opportunity and how you are expressing that view through the portfolio. With that, let's open it up to the audience now. We have several questions coming in. So let me start with the first one. Betty, the first question is for you. As we look at the earnings cycle, do you think the downgrade phase is behind us? And where, if anywhere, do you think consensus earnings expectations may still be too optimistic?
I think quick answer to that, Sonal. The simple thing is that I think the downgrade phase is behind. The only thing that I would say is that 17% earnings growth is still, to my mind, a high bar. Not impossible, given that the first quarter for Nifty 500, 390 companies is running at close to 14%. But it is an ambitious bar. But I think the worst of the downgrade cycle is behind us. As I said, nominal GDP growth itself being in double digits is a big positive.
Thanks, Vetri. Vicky, my next question is for you. Is current consumption recovery cyclical or structural in your view? Is it largely driven by easier financial conditions, policy changes such as GST rationalization, tax relief, or there is a genuine structural improvement in India's consumption cycle?
Oh, okay. Thanks, Sonal. Thanks for that. See, the consumption growth story is structural per se. There is an underlying aspiration and underlying demand that we are capturing, and I've talked about those opportunities. These are very, very strong opportunities within India. So these are structural opportunities. The income growth is required to support the capturing of these opportunities. And whatever we have done and whatever the government or the regulators have done in terms of GST cuts or in terms of income tax cuts is supporting that part of the story. So in a way, these are the enablers of the consumption story, which is a very structural story in India. And as long as the demographic dividend continues, as long as the disposable income grows, I'm quite confident we have a very, very strong structural consumption theme going forward.
Sure. Thanks, Vicky. My next question is again for you. If commodity inflation remains elevated, would you prefer companies with strong pricing power or companies that can protect margins through cost efficiencies and premiumization?
Okay. Okay. So that's a that's a little bit of perplexing question. So, but let me express how I think about these. Inflation is transitory, so you will have these volatility of inflation. Sometimes it will be high, sometimes it will be low. Our preference for companies are those ones, and when I said these are strong executed companies that I prefer because they know how to navigate high and low inflationary environment and still drive consumption demand, right? And they would use every lever. They would use value engineering, they will use pack sizing, they will use the SKU laddering to drive and enable the consumer demand even during inflationary times. Pricing would be the last lever that they would generally tend to use during inflationary times. So a company that is executing well tends to kind of navigate these inflationary cycles way better. And that's why, our preference stands at the same place. We still prefer companies that execute well.
Sure. Thanks, Vicky. Betty, we have a question on one of the slides you discussed today on accelerating global earnings growth across regions and countries. The question is, why will the earnings be low for Korea and Taiwan in FY27? What they are producing now will be consumed only in 2026. Should the demand for such things be continuous?
Actually, there is still pretty strong earnings growth for Korea, Taiwan in 27 as well. Just that this 25 to 26, if I remember right, for Samsung Electronics, it's almost like a 7 or 8-fold increase in profits. So from that base, it is then slowing down, but slowing down to still 25-30% rate of growth. So it's just normalizing as opposed to being exponential in the previous year.
Sure. In the interest of time, I will just take two more questions. Vicky, this question is for you. If you look beyond the obvious consumption winners that the market already recognizes, where do you see the next wave of consumption companies that could deliver disproportionate earning growth over the next 3 to 5 years?
So in a way, Sunil, I think I just fall back to the same things. Generally, it's more like there is no reason to believe that the companies that have been able to capture these opportunities today will not be able to capture these opportunities tomorrow. And the opportunities are the same that I talked about, right? The three major themes of unorganized to organized, of convenience, and of premiumization. But in that scene, we are also seeing many of these companies that are coming through because of the advent of these digital commerce that are in great position to capitalize on these demand. They have kind of their moats are very deep. They have they have created logistics moats. They have created modes of having consumers, having very high active user base. So these deep moat companies that are platform based, that are low capital, low working capital, low fixed capital, low working capital based companies, where I think with scale they will also drive very healthy profitability. So those companies could be winners, but at the same time, I think retail market is large. I think there will all formats will coexist, and in my view, many of the incumbents would be very strong winners in future as well.
Sure.
So it's more
Thanks,
about
Vicky.
capitalizing on those themes in a way.
Yeah. Thanks, Vicky. Vetri, my last question is for you. You've spoken about investment heroes and villains in your commentary this month. If you had to give investors a few simple principles to identify the heroes, avoid the villains, and stay focused on long-term wealth creation, what would you say?
Well, I think it's pretty much in the hands of those, heroes and villains. I think the biggest villain is the fear of missing out, because people actually always seem to worry more about their investments because somebody else's investments are doing very, very well. And I think that envy is actually the downfall of most analysts. So that fear of missing out, to my mind, is what has hurt most people in terms of achieving their investment goals. I think the most the biggest hero of anybody's investment journey is actually patience, which, as I always keep saying, that in the journey of compounding, actually the most relevant variable is N, which is the number of years, and not R, which is the rate of return. And therefore, I would say the silent hero of compounding, the unspoken hero of compounding, who will enable you to achieve your goals, is that patience and the time you remain invested in the market.
Thank you, Vetri. With that, we come to the end of today's conversation. We have covered quite a bit today, from the broader market and macro outlook to the opportunities and challenges within the consumption space, and how that is reflected in the UTI India Consumer Fund. Vetri and Vicky, thank you both for your time and for sharing your perspectives with us. And a big thank you to all our participants for joining us today and for the questions. Thank you, everyone. Have a great evening. Stay focused and stay invested. Namaste.
Thank you. Have a good evening, everybody.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.